All right, my friends. Happy hump day. 5 o'clock somewhere. This business makes me feel like it's 5 o'clock all the time. I stopped drinking, though, for real. All right. Pipe down, chill, listen. We're going to have to discuss some uncomfortable truths today. Essentially, we've got a scenario where things have gotten a little bit ugly. I'm going to talk technically. We're going to look at interest rates specifically. And we're going to talk about the Fitch downgrade. We're going to talk about the stock market overall. We're going to talk about the bond market overall. I'm going to start right here on bonds because I kind of gave a warning shot yesterday. I know a lot of people saw it and they're like, hey, wait a minute. Things going to hell in a handbasket. Not exactly, but there was that possibility today. It could have been worse. Lost 17 basis points today. And that it could have been so much worse. We were down like 50 plus at the low of the day today. I mean, it was bad. And I'm sitting here looking and going, well, this is the last bit of support right here. So this is the bullish order block right here. This guy that we would like to see bounces off of that level. And if you can see it held, we closed above it. That's good. That's good. So the buyers who were buying this dip after this gap down, they're still around. That's a good sign because as you can see, we have not been able to make it through the three amigos, 25, 50, and 100-day moving averages. We just haven't been able to get through them. We poked our heads above a little bit, but every time we've gotten up in there, it's just rejected. Plain and simple. Remember, we want to see bond prices go up because that means that mortgage rates would be going down. Okay? That's what we're looking for. That's what we're hoping for. We're not seeing that right now. We're also going to look at the dollar index, which will help explain sort of how the Fed's deflationary actions have had an impact, but how the Goliath that is inflation right now is proving to be quite formidable on a lot of fronts. In the real estate space, particularly, as we see rates keep going up, cash buyers keep coming out of nowhere, and property values aren't really declining. We're going to look at property values as well, specifically today. But I just want to start with the interest rate tip because, a lot of people have been asking me, hey, I thought you said, interest rates should improve. I really feel like they should. I mean, the Fed's taking crazy actions. We've got interest rates so high. You can get a CD at the bank now for 5%. I can't believe Wall Street's allowing that. Cannot believe it. Because they definitely don't want that. They want your money. They don't want you to be able to just stick it in the bank and make all kinds of interest. And that's one of the things that should propel rates lower. But as we see, okay, this is Mortgage News Daily right here. So that's average rates. Here's my rates. I want to leave those up just so we can see that, we've got rates. Some rates are in the 7s now. But for FHA, we're still mid-6s. Jumbo, you can get those arms in the mid-6s still as well. So it's not terrible, but how would we be looking if rates went up 0.5% or 1%? That could really slow things down. A lot of markets don't have as many cash buyers as we do in San Diego. So many all cash sales. It's just crazy. I mean, just people just pouring in cash. You don't have that in a lot of the other markets, even though price points are lower. So I don't think it would affect San Diego as much. But looking on a global scale, or I would say global, a national scale, it could have different implications. Let's take a specific look here at the average sales price. We got the data from last quarter is in. Let's shorten this guy up. As you can see, when I talk about real estate long-term, that's what I'm looking at. That's the graph, okay? That's going back to around 1960. Real estate goes up and to the right. That's why I like it as an investment. Don't have to be a genius. Don't have to be perfect. Don't have to pick the perfect time. Don't have to buy the dip. Just buy it wherever you can get in. You're going to be good. But let's zoom in a little bit more specifically. Let's come into, let's say, last several, let's say 8 years. Okay. We've seen this big run up here. This was the COVID recession, mild and quick one. And then we pop up here Now, we started to top off Q4 of last year. Still had an increase in Q4, but you could see it started to top off. Then Q1 of this year, we had a nice drop. I was surprised to see Q2 was also negative. Now, this is nationwide, okay? Q2 also negative, almost 3%. Was surprised to see that. Now, this is the average sales price of houses sold. It doesn't necessarily mean the market's going down or up. It could mean that higher priced homes are not selling and more lower priced homes are, that kind of thing. I have to take some of these numbers with a grain of salt, but it does give us an idea of what's taking place. And while the decline seems to be decelerating, there is still a decline there. Now, one of the things I'm going to point to, and let's just go ahead and talk about it, is something that's happening in the UK. Now, one of the things that they do that's different than here is a lot of the people who buy there have adjustable rate mortgages. You may have heard of the LIBOR, the London Interbank Offer Rate. It's what a lot of the ARM rates are queued off of, and a lot of people there have ARMs. So this higher interest rate environment has actually been really, really affecting people. One of the reasons why I'm a big proponent of the fixed rate mortgage. Nothing wrong with getting an ARM, if you do it knowingly. But these people have ARMs that they're just writing. And so year after year, it's adjusting. And lately, that's been up, 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 up. That's really affecting things. It's affecting how much interest people are paying, what their mortgage payments are. It's affecting how much people have to charge other people in rent. So if there's ever an example of how ARMs could really mess up an entire market, this is an article I recommend you read, because this is what we want to avoid. And fixing in costs and refi opportunities are great ways to do that. Okay. Also seeing right now, foreign buyers seem to be bailing on the U.S. housing market. This has a lot to do with the currency side of things, which we're going to be looking at the dollar index and talking about what the Federal Reserve has done to inflation and how it's been so persistent, how you can see it on a chart. But we've noticed this as well for sure. A lot of international buyers purchased 14% fewer U.S. homes in the past year. That's the least since NAR started tracking it in 2009. So foreign buyers seem to be not super bullish on real estate in the United States. Why is that? There's a lot of reasons we could speculate. But let's just take the fact for what it is. Median price of homes they purchased was about $400,000, which is the highest NAR has ever recorded. And that's because prices, like I said, overall have still remained quite high, even though rates have gone up. And while nobody knows what's going to happen next, we do know what happened yesterday. Fitch, which is the ratings agency that cut the U.S. long-term debt from AAA to AA plus during the debt ceiling debacle. If you guys remember that happening in Congress between the House of Representatives and the president, there was a debt ceiling issue. Congress wasn't willing to fund. White House wasn't willing to budge, so on and so forth. Anyway, long story short, they resolved it. They got the AAA rating back. That sent bonds into a tailspin. And that's the reason why yesterday when this came out, I was like, hey, we may have a problem tomorrow. If this happens anyway like it did last time, we could see rates go up. So what happens to the market if rates go up half or a full percent from here? What if we have rates in the 8s? That's something that's actually on the table now. I would have told you before yesterday it was not on the table. That was frankly an impossibility. And it would take some sort of thing from left field that people didn't see coming. And then we got that thing. So we got to pay attention to this. This means we could see higher rates. Now, for some people will hear that and they'll go, oh man, I need to hurry up and buy before rates go higher. And I understand that thought process because, hey, if rates go lower, then great, you just refinance. Some people may say, well, I'm going to wait until this shakes out. And I also understand that. Hey, listen, if rates go up a bunch, then maybe, maybe prices will come down. The problem with that logic, though, is just that it doesn't encourage people to sell. Oh, man, where was that? Did I save that link? There's a link I'm going to send to my realtor friends in the next week or so. But basically, it was talking about, I wish I would have had that on here, talking about how most home sellers today are people who have rates at 5% or higher, and that most people who have a rate below 5% won't sell their home because they don't want to trade at 3 or a 4% for a 7% or a 6%. They just don't want to. And so the sell buyers, who make up a very important chunk of the real estate market, are sort of non-existent. Not completely, but mostly. And so rates going up would only, in my opinion, further exacerbate the inventory issue and further perpetuate the inflationary activity that's taking place in housing. So while I could be wrong about that, I have been wrong before, once or twice, very rarely, but it happens. So I don't expect that to happen, but it's now on the table. We now have to talk about it. Because if there's another downgrade, if there's something else that piles onto this by itself, maybe you saw this. I don't trust this guy at all. Not one bit. But JP Morgan Chase CEO Jamie Dimon said that the Fitch downgrade was ridiculous. Oh, okay. Jamie, have you been paying attention to what's going on with BRICS? Have you been paying attention to all the people who are abandoning the US dollar? Yeah, that's happening. I think that they are within the bounds of reason to make a downgrade here. I do. He said it's ridiculous that other countries are rated higher than the U.S. when they depend on the stability created by the U.S. and its military. That makes sense. But is the United States going to use its military to force people to use our currency? Because if they aren't, then these guys are right and you're wrong, James. Anyway, Treasury Secretary Yellen also said she was surprised. She said it's completely unwarranted. Entirely unwarranted, she said. Surprising. Treasury securities remain the world's preeminent safe and liquid asset. Now, with the Federal Reserve, I agree. Liquidity is something that can be created anytime. I mean, when you have a Federal Reserve that can just print money whenever they feel like it, you can kind of save the day if there's a liquidity crisis, right? But that doesn't mean that it's stable. That doesn't mean that it's not. I mean, look, AA plus is still a very high rating. These two nincompoops, knuckleheads, are acting as if, it's gone from AAA to F. It's gone from AAA to AA plus, which is still a very high rating. It's not the highest possible rating, but still a very high rating. So you have to remember that. They're not saying the sky is falling. They're just saying, one notch lower. I think that's reasonable considering how many people are abandoning the U.S. dollar. Countries left and right abandoning the U.S. dollar. And that charge is being led by China and Russia. They are together leading that charge away from the U.S. dollar. Buy your Bitcoin, folks. Buy your Bitcoin, not financial advice. All right, so we got the downgrade. These two people, foreign buyers, UK crisis, and then today we got great jobs data. It's so weird, right? Inflation is so hard to describe. It's so hard to explain. The best way I can explain it is you just have too much money in the room. If you take the whole of the United States economy and you just talk about just one room full of people, that room has too much money in it. And those are the kinds of rooms where people pay $1,000 for a 3-course meal. So when you have too much money circulating around, then it gets spent. And when money gets spent, jobs get added, inflationary activity continues. And the Fed is trying to slow this down by essentially, what would you say, like drugging the economy with higher interest rates? They're trying to sedate the economy with higher interest rates, which is sort of a managed crash. Hey, we don't want to actually crash the market, but we want it to stop growing. So we have to do things that would cause a crash if we did it too much. They're meddling with it. They're messing with it. And I'll just show you. That's Meta. We'll look at that in a second. I'm going to show you my favorite stocks and everything and then stock market and whatnot in a minute. This is the dollar index right here. Let me see. Am I in the way? Okay. So these arrows represent the Fed's actions in raising rates or decreasing rates. There'll be downward arrows that will be on the top whenever they decrease rates, assuming that they do at some point. And what you can see here is zoom out. Okay, so that's 25 basis points, one arrow. 2 arrows is 50 basis points, and 3 arrows is 75 basis points. So now you can see when they were aggressively, and down here is just anticipation of the aggressive hiking. As they were aggressively hiking 75 basis points, look what was going on. Dollar was getting super strong, right? I called this almost the exact top up here, called 114. It just went to 114.8. And remember, this is when I said, hey, I think you should be rotating out of dollars and into other assets, whether that be real estate, stocks, whatever. This was the time. And that was September of 22. Oh, gosh, I call the freaking bottom of the stock market or what? So that was what was going on. You can see once the aggressive hiking stopped, it was as if the market knew that was coming. And you can see here now they're hiking it. They're still hiking, trying to hold the strength up. When this security right here, when this dollar index is going down, that's inflationary. When it's going up, that's deflationary. So you can see without the manipulation, as the manipulation is pulled back, it just shows you the hand of the market. And the hand of the market is showing you inflation. This is the reason why the Fed raised rates again. This is the reason why they've said we're not necessarily done raising rates, because they are trying to get this inflation monster under control. And it's a very, very, very big beast that they're fighting. And it's potentially a bigger beast than any of us thought. While that is good for people who own assets, typically, like stocks, real estate, so forth, it's tough for people who are renters. It's tough for people who are making median incomes. It's tough for people who are just barely getting by, which is the vast majority of people. That's fact. And that's what we're faced with here. We're staring down the barrel of this thing. Now you can see I've plotted the downward trajectory here. We're in a downward channel. Oh, look at that. Look at how it danced around it. A little fake out and came back up. That would have been beautiful to trade. I don't trade this, but it is what it is. So you can see we're in the downward channel. It's holding, getting close to a point where we might be saying, hey, we're approaching, potentially breaching the top end trend line of this downward channel. And that means that we, could see a new trend higher if the Fed decides to hike, or we get some deflationary data, or it could reject again and we could continue to see inflationary action. And that seems to be what the market is predicting. Not that, it's a horrible thing if that happens necessarily, but it's not the direction we really want to see things going. We want to see inflation relax a little bit, okay? So that we can I get this? So that we can look, okay, this is our chart. I drew it up here earlier. Well, because what we really want to see is we want to see the bond market come back to life, right? That's what we want to see. We want to see bond prices go up here and just lower rates a little bit. Like, listen, we don't need 4% mortgages. I don't want overnight 4% mortgages. I would like to see a slow decline in interest rates. But one thing's for sure, we really need them to stop going up. And in order for that to happen, we're going to need inflation overall, big picture inflation, to chill the F out. And it just won't. So that's where that's at. Okay, let's look at a couple other things. Stock market. I'm going to eat the crow too. I was wrong. I sold my Meta a couple days before I should have. I'll show you that chart where I screwed up. This is the S&P 500 right here. Now, we've been in this upward channel, as you see, for quite some time, since we made our bottom in October. Remember, September was when I was saying it's time to rotate in assets. Damn near called the exact bottom of everything. That was 1,000 points, S&P points ago, 4,000 ticks. Crazy. So we've been in this channel for a while. And look, we're at the top end of this channel. We also, not only did we coincide with the top end of this channel right here, but also this bearish order block over here, this high that came in March of 22. That daily high right there, bearish order block. We opened up in it on Thursday and have rejected pretty hard since then. Just getting to the 21 EMA though. So all hope is not lost. But look, in these channels, price goes up. The whole point of me drawing these is because it's amazing how often it's the case. Price will follow these channels. Go down and touch the bottom, go up, touch the top, go down, touch the bottom. And then when it breaks out of the channel, you can confirm the trend change. Okay, this is a daily chart. So in order for us to really say, hey, we've got a trend change here, we would need to see price come down and break this and then stay below it. That's a long ways from here. So I'm not necessarily calling a top here. I am, though, expecting downside. I am bearish in the short term for sure, and I'm thinking about how much, if any, of my Tesla I'm going to sell. We'll pull that chart up as well. So right now, it makes sense why we're getting rejection. Even if we were going to maintain bullishness here, we're going to reject potentially another 60 or 80 points, and it could still be bullish. Like coming back to this old resistance right here, which coincides with this fair value gap, that right there, which is like 60 points below here, we could still continue higher from there. It's possible. But the Fitch downgrade, market frothy, inflation persistence, I don't know. I don't know if we get too big of a bounce there. So that's my main concern on that front. You've seen a lot about Bitcoin lately. Bitcoin is also in a channel, has been for a long time. Everything is in a channel, I'm telling you. And it also makes sense why Bitcoin rejected up here, because this particular channel right here, which was created a long time ago. How far back do I have to go to find that thing? Stretch that down just a tad. Oh, there it was right there. Boom, boom, boom. It makes sense why it's rejected here. Look at that. So going all the way back years. I just went back years to fix that. And you can see, look, midpoint, bounce off of that, come to the top, bounce down. This makes sense too. So a lot of people have been asking me about Bitcoin. They know I'm long Bitcoin. I don't see anything here that's really too disturbing to me to be too concerned about. When price goes up to this area, when it's touched this line before, it's rejected. Come back to the midpoint. If it bounces off the midpoint, that's a good sign. So, I mean, we could be back to 25, 26,000, bounce back off the midpoint and continue higher. And there's nothing that's changed from a macro outlook on that. So while we may see downside in the near term, still very much macro bullish on Bitcoin. All right, we looked at the dollar. Let's do Tesla. I know some of my buddies own Tesla. Let's take a look at it. Tesla's a little bit different situation here. What you'll notice is this trend line here. Every time it's been touched, major rejection. Well, we closed above it for the first time in years on Tuesday, July 18th. That was the first time we closed above it. Immediately, the following day, actually, we closed above it the following day too, even though it was a red candle. And then we got the massive gap down a day after earnings. Okay. And by the way, the earnings report from Tesla was very strong. I mean, it was very strong. In my opinion, the earnings call was strong. A lot of things going well for them. Have margins been cut a little bit? Yes. But revenue and profits, records. Deliverables, potentials, insane. Advancements with the robot, crazy. Crazy. Do you realize in 10 to 15 years from now, you're going to have a fully functioning Android robot in your house? I know you will, because they're going to make them for like 20 grand. And I bet you'll be able to finance them for like $300 or $400 a month. They'll do your laundry. They'll probably cook you food. I'll do all kinds of stuff. I'm telling you right now, be nice to those dang robots. And when you ask Siri to do something, you better use your manners. And if you're typing into Chat GPT, you better say, thank you. You're so helpful. Show some manners to these robots, because who knows what happens down the road. You understand what I'm saying? So this is ugly. If price gets back up to here on Tesla, I'm a seller. So I'm probably going to put some sells in at around 280 or so, in case price gets up there. I don't think I'll sell it any for too much less than that. But if price gets back to 280, it's almost certainly going to reject. I'm not going to sell everything. I will sell a piece, maybe 20 to 25%, with the hopes that I could buy that back later at a cheaper price. Just sort of trade around the position. Meta, I got all out on, and we've been in this channel also forever. I got all out on Meta, like the day before. So it crossed the midline here. It crossed the 21 EMA. And I was like, okay, it's finally dead. We got, bearish fair value gaps, multiple in a row. This thing is dead, right? Look at this. Multiple bearish fair value gaps, back-to-back days, heading into earnings. Like, all right, it was a fake out. It was a fake out. I got faked out. Now, I closed for a massive profit, but I still got out too soon. The very next day, 2 days later, after I said I'm all out on Meta, it spiked up like $20 a share. Just crazy. It's okay. I'd rather sell too early than too late. I'm good. Getting a bounce down here, expecting this thing. Now, this bullish fair value gap right here, coupled with the 21 EMA, I may have to get back into the sucker. On top of that, we have the midline here of the channel. I mean, right in this area, right pretty much where it is, would be a decent place to start putting stuff on. And if you're wrong, you do have a bullish fair value gap down, or bullish order block right here as well, down in the low 290s. So you could start here, buy some, and then you could add some here. And then if we lose this channel altogether, then you could get out. But that's what I'm looking at on Meta. So we'll see. We'll see. I may have to get back into that bad boy. I wanted to book some profits on something. I just saw a lot of bearishness, and you can see we've seen a lot of selling here in the last several days. So I feel like when I see that coming, I have to ring the register on something, and I just chose Meta, and I chose the wrong one. It's just what it is. Gold has also been signaling some stuff to us. Gold, you expect, like, if gold is a flight to safety asset, right? So when we look at this, we go, all right, hey, when did we hit our high here? It was May of this year, not that long ago. Okay, gold got up to 21.43 an ounce in the futures market. 21.43. Some people are saying, oh yeah, gold will hit 3,000, gold will hit 4,000, gold will hit 5,000. I don't think we're going to see that, but a lot of people very interested in it. Look, gold has been selling off. So when you try to get super bearish about the market, I always come and look at this and go, well, wait a minute. Not a huge flight to safety going on here. Seems like people are running away from gold, which is also a little bit counterintuitive based on what we've seen and what we know is happening with BRICS, the de-dollarization, all that stuff. So something's not adding up. Something is not making sense here. What it is, we'll find out eventually, right? So I just didn't mean to do that. So ultimately, here's what we've got going on. Do a quick recap. Totally forgot to look at comments. Yeah, good point. Lynn, well, the summit of the alternative currency, India said they are not happy, and they are one of the big players in BRICS. It's true. Yeah, we got India, you've got China, you've got Russia, you've got some very big economies. Africa, a lot of these places are wanting to abandon the dollar. They just simply don't appreciate some of the things we've done. And I hate to be the one to break the news, but it's possible that we've been the bad guy a lot of times and we didn't realize it. I always thought we were the world police. We were the good guys. It's starting to look like there's a good chance that in some of these instances, at least, some of these different wars, regime changes, quite possibly we were the bad guys and we didn't realize it. And that may be coming back to haunt us here in the very near future. So with de-dollarization, you kind of pick your backup. What do you want? You want gold? You want Bitcoin, digital gold? What do you want? I think it's good to have some exposure to lots of different asset classes here, but most importantly, this one. Because the one thing that's survived everything Real estate right there. And now you know why I'm so bullish on it, because that's the chart. I don't have another chart that looks like that except for like the stock market chart. Same thing, right? Over that period of time, just up, 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 up. So I like stocks, particularly growth-oriented ones. And I like real estate a lot. I like Bitcoin a lot. I have a few other little cryptos, just almost wish I hadn't, but I do. And I think in the very near future here, we're going to find out what's what. This is, let's see if we can get a little bit longer. That's the last year in the bond market right there. Not very bullish. It just looks like the backside of Everest, just going down, 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 down. We need that trend to change. We need that trend to reverse. Over here is where I thought it was reversing. I mean, look at it. Doesn't it look like we're bulling up? I mean, look at this thing. 25 SMA started crossing over, and then we just went sideways, and then we died. Debt ceiling debacle. Ugh. Killed us. And there's just been one of those events after the other, and we just can't get on the other side of it. If we do, when we do, what we're going to see is we're going to see interest rates plummet. Didn't mean to do that. We're going to see interest rates plummet. And we're going to see the housing market go bananas. But between now and then is what I'm talking about. Between now and then, the possibility of higher interest rates is really there. It's right in front of us. It's very possible. The possibility of the real estate market getting even thinner, meaning even less homes for sale, also upon us. And there's not much you can do about it. There really isn't. But I personally am buying real estate right now. I will just tell you, I am pulling triggers. Okay. Me personally, I'm out here trigger pulling. Why? Because I know what happens when rates come back down. And even if prices go down 5 or 10% from here, which I think is probably the worst case scenario, I know what happens when rates go back to 5, 4, 3%. It's going to be
all we want to do is pump you up.
Yeah.
It's going to be significant. It's going to be a huge bull run. Will we have to get through some choppiness? Will we have to get through a few dark days? That's quite possible. And I'm seeing that being more possible now than I have in recent days. But I know what's on the other side. And so for me, I am personally writing offers right now. Investment properties, I'm writing offers. So I'm going to close it with this. Let me start my music up. It's time to be wise. It's time to pay attention. It's time to be less emotional, more tactful, more calculated with your investments, with your inflation hedging, aka real estate purchasing, or gold, I guess you could say, but gold has been tracking with the DXY, so I don't like that one. Digital gold, crypto, Bitcoin. Are you prepared for that? If you're in this business, if you're a realtor, if you're a loan officer, are you prepared for things to be slow for the next year and change the way that has been this year? If not, you need to get there. Still unknowns out there in the short run. Be prepared, my friends. Have a great night. Peace.